In this video, we're going to delve into the fundamental principles that Warren Buffett, one of the most successful investors of all time, follows to build his immense fortune. Understanding these principles is vital for anyone looking to start their investment journey, especially those with a limited budget. Warren Buffett is widely recognized not only for his wealth, but also for the simplicity and clarity of his investment strategies. One of his most famous mottos is rule number 1, never lose money. Rule number 2, never forget rule number 1. This seemingly simple approach conceals a world of wisdom that can transform the way you think about investments. One of the key pillars of Buffett's philosophy is the importance of investing in companies with enduring competitive advantages. He believes that instead of over-diversifying, you should choose a few companies that demonstrate strong long-term growth potential, a strategy he calls focusing on the economic moat. This moat represents the barrier that protects a company against fierce competition, such as a strong brand, patented technologies, or a robust distribution network. Furthermore, Buffett is an advocate for patience and discipline. He often buys stocks with the intention of holding them for decades, selecting companies he believes have a promising future. His philosophy goes against speculative investment, where people frequently buy and sell stocks trying to predict short-term market movements. He recommends ignoring market fluctuations and focusing on the long-term performance and potential of the companies you invest in. Another crucial principle is the importance of maintaining an emergency fund. Buffett always emphasizes the need to have a cash reserve that allows you to withstand periods of crisis without needing to sell assets at unfavorable times. Understanding and applying these basic principles, even for those starting with limited resources, can adopt a solid long-term investment approach, laying a foundation for building wealth over time. Understanding your financial starting point. Before embarking on an investment journey and wealth building following Warren Buffett's principles, it's crucial to understand where you are starting financially. Recognizing your starting point will help define realistic goals and create an appropriate action plan. Understanding your starting point. The first step is to take a detailed inventory of your current financial situation. This includes listing all your sources of income, monthly expenses, savings, debts, and any assets you own. Having a clear overview will allow you to devise more effective strategies to move forward. Income and expenses. List all your sources of income, such as salaries, freelancing, or any other regular financial inflow. Then, note down your monthly expenses, categorizing them between essential and discretionary. This analysis will help identify areas where you can save and redirect those resources towards investments. Savings and debts. Evaluate how much you have saved so far. If you don't have savings, it's important to start creating an emergency fund, which ideally should cover 3 to 6 months of your expenses. Concurrently, take stock of your debts, including credit cards, personal loans, or any other financial obligations. Paying off or minimizing debts is a priority before starting to invest, as high interest rates can hinder your financial growth. Analyzing your assets. If you have any assets such as property, vehicles, or existing investments, consider their value and how they can contribute to your long-term strategy. Sometimes it may be worthwhile to sell non-essential assets and use those resources for more productive investments. Setting financial goals. With all this information in hand, establish clear and achievable financial goals. Set specific deadlines and values for each objective, whether it's paying off a debt, saving for an emergency fund, or starting to invest. Well-defined goals serve as a roadmap for your financial journey, providing guidance and motivation. Understanding your financial starting point is crucial for charting a solid path towards wealth building. With a clear view of your current situation, you'll be better prepared to apply Warren Buffett's principles and make smart financial choices that will ensure a prosperous future. The importance of mindset and financial education. In this chapter, we'll explore one of the fundamental principles of achieving financial success: the right mindset and proper financial education. Often underestimated, positive and proactive thinking, coupled with solid knowledge of finance, can be the necessary difference to transform a limited financial situation into a path of prosperity. The road to wealth requires more than just good investment strategies. It requires a strong and well-directed mindset. Without the right mindset, any financial gain can be quickly lost. Therefore, before delving into the technical details of investments, it's crucial to establish the mental and educational foundation that will support all your future success. The first step in developing a successful mindset is believing that you can indeed achieve financial independence. This involves reframing limited beliefs that may have been internalized throughout life, such as wealth is not for me or I will never be good at managing money. Instead, adopt a growth perspective where every financial challenge is an opportunity for learning and development. In addition to mindset, financial education is equally essential. Invest time in learning about personal finance, how to budget, understand interest rates, and the importance of credit. Financial education provides you with the tools to make informed decisions, avoiding common pitfalls that can lead to debt and financial instability. The combination of a resilient and positive mindset with a solid foundation of financial knowledge creates a robust platform for growth. Study quality materials, participate in free or paid online courses, and read reference books. The more knowledge you acquire, the more confident and capable you'll feel to make sound financial choices. Finally, never underestimate the power of the mind allied with knowledge. Warren Buffett, one of the most successful investors in history, firmly believes in the importance of continuous education and constantly updates his knowledge. Follow his example and make learning a daily habit. That way, you'll be better equipped to make financial decisions that will help you achieve the wealth you desire. How to save money, even with a limited budget. In this topic, we'll cover practical strategies for saving money while living on a tight budget. The first step for any wealth-building journey is learning to save, and this is especially crucial when starting with limited resources. Let's explore various ways to save money in everyday life, allowing you to redirect these funds towards future investments. Saving money may seem challenging when the budget is tight, but with some strategic adjustments, it's possible to create a significant financial margin. Firstly, it's essential to analyze all your monthly expenses. By tracking every penny that comes in and goes out, you can identify areas where cutting back is feasible. Using financial management apps can assist in this process, making it easier to monitor expenses. One of the most effective ways to save is by reducing unnecessary expenses. Review your subscription services, such as cable TV, streaming, and gym memberships. Often, we forget to cancel those we don't frequently use. Substituting eating out for homemade meals can also yield substantial savings. Instead of buying coffee daily, consider preparing your own beverage at home. Another practical tip is to embrace a minimalist lifestyle. Evaluate the necessity of each purchase and ask yourself if it's genuinely indispensable. Additionally, buying used items, such as furniture and clothing, can help reduce expenses considerably. Thrift stores and online marketplaces offer good options at affordable prices. Finally, develop the habit of automating your savings. Set up an automatic transfer of a portion of your salary to a savings or investment account. This ensures that you're building your emergency fund and laying the groundwork for future investments without the temptation to spend that money. Saving money on a limited budget requires discipline and planning, but with these strategies, you can accumulate resources to start your investment journey and eventually build wealth over time. Fundamentals of long-term investments. Long-term investments rely on some basic premises: patience, consistency, and selecting solid assets. Patience is crucial because significant returns are often reaped over many years, rather than short periods. Consistency involves regularly practicing investing, regardless of market fluctuations. Choosing solid assets requires careful analysis of companies that possess enduring competitive advantages and have demonstrated resilience over time. To begin, it's essential to understand the concept of intrinsic value. Warren Buffett believes it's vital to analyze whether a company is trading at a price lower than its true value. This requires some understanding of the company's financial statements, such as balance sheets and income statements. Indicators such as low debt levels, high cash generation, and consistent profit growth are signs of a financially strong company. Another key point is understanding economic cycles and the ability to maintain a long-term view, even during periods of recession. In the short term, markets can be volatile, but history has shown that, in the long run, markets tend to reflect the real value of companies. Furthermore, investing in companies with growth vision and competent management can maximize your profit potential over time. Analyzing growing sectors and diversification are also important features to minimize risks and maximize returns. Identifying solid companies with enduring competitive advantages. When it comes to investing like Warren Buffett, the ability to identify solid companies with lasting competitive advantages is crucial. In this chapter, you'll learn to recognize the characteristics of businesses that promise longevity and success, regardless of momentary economic conditions. To start, it's essential to understand the concept of an economic moat. This term, popularized by Buffett, refers to a company's ability to maintain competitive advantages that protect its market against competition. Companies with wide economic moats possess special attributes that make them difficult to surpass, ensuring their ability to generate consistent profits over time. One of the primary ways to identify an economic moat is by analyzing the company's brand and reputation. Strong brands, such as Coca-Cola and Apple, have global recognition and a loyal consumer base. These companies can charge premium prices for their products, resulting in higher profit margins. Another factor to consider is the switching cost for the consumer. Companies that provide products or services that, once adopted, are difficult to replace without significant costs to the user, such as enterprise management software or subscription services, also have robust economic moats. An example is Microsoft with its Office suite, widely used in the corporate environment. Additionally, scale advantage can be a distinguishing feature. Businesses that operate on a large scale, such as Walmart or Amazon, can significantly reduce costs and offer lower prices, attracting more customers and making it difficult for new competitors to enter the market. It's crucial to also evaluate the innovation factor. Companies that continually invest in research and development to introduce new products or improve existing ones stay ahead in the market. Google and Tesla exemplify this strategy, continuously releasing innovations that shape the future of their industries. Lastly, always keep in mind that financial solidity is crucial. Companies with healthy balance sheets, moderate debt levels, and strong cash flow are better equipped to withstand economic crises and continue growing. Identifying solid companies with enduring competitive advantages requires patience, research, and discernment. However, by mastering this skill, you'll be following one of Warren Buffett's fundamental principles and paving your way toward long-term financial success. Diversification strategies to minimize risks. One of the most impactful lessons we can learn from Warren Buffett's investment philosophy is the importance of diversification to minimize risks. In this chapter, we'll explore effective strategies for diversifying your investments, especially if you're starting with a limited budget. Proper diversification can protect your portfolio against inevitable market fluctuations, providing security and growth over time. Diversification means spreading your investments across different assets to reduce your exposure to risk in any specific area. Buffett often warns against putting all your eggs in one basket. By spreading your investments, you lessen the negative impact that poor performance in a single asset could have on your portfolio. For beginners, the first step in diversification is identifying different asset classes, which can include stocks, bonds, index funds, real estate, and even commodities. Even with a limited budget, you can invest diversely through index funds or ETFs, exchange-traded funds, which allow you to purchase small stakes in a wide range of assets. Another crucial aspect of diversification is spreading your investments across different sectors of the economy. For example, if your portfolio includes stocks of technology companies, consider adding stocks from sectors like healthcare, consumer staples, or industry. This balancing act helps cushion the impacts of sector-specific crises. Lastly, it's essential to periodically review and adjust your portfolio as new data and circumstances emerge. Diversification is not a one-time action, but a continuous process. Staying informed and adaptable will ensure that your diversification strategies remain effective and aligned with your long-term financial goals. The power of compound interest and dividends. In long-term investments, understanding the power of compound interest and dividends is crucial. These are two concepts that Warren Buffett greatly values in his investment philosophy. In this chapter, we'll explore how both can turn small initial investments into significant wealth over time. Compound interest, often referred to as the eighth wonder of the world by Albert Einstein, is the foundation of long-term investing. The idea is simple. You can earn interest not only on the initial capital, but also on the interest already accumulated. This creates a snowball effect where, over time, your investments grow exponentially. To illustrate, imagine you invest $1,000 with an annual return rate of 10%. In the first year, you'd have $1,100. In the second year, you'd be earning 10% on $1,100, not just the initial $1,000, and so on. Over the years, the amount grows impressively. Dividend is the portion of a company's profit distributed to shareholders. Solid and well-established companies often pay dividends regularly, and Warren Buffett has always emphasized the importance of investing in them. Dividends can serve as an additional source of income, reinvestable to further leverage the power of compound interest. This means that even if the stocks aren't experiencing significant growth in value, the received and reinvested dividends continue to generate additional returns. Both compound interest and dividends act as powerful allies in building long-term wealth, especially for beginner investors with a limited budget. Over the long term, these financial forces can turn small initial amounts into substantial sources of wealth, as long as you maintain discipline and patience, central principles in Warren Buffett's philosophy. How to invest in stocks with little money. Investing in stocks can seem intimidating, especially if you're starting with limited resources. However, with proper strategies and a clear understanding of the process, it's possible to start investing with little money and reap the rewards over time. This chapter will show you how you can begin your stock investment journey efficiently and intelligently, even with a modest budget. First and foremost, it's essential to understand that investing in stocks is not a game of luck, but rather a practice based on analysis and planning. The first step is to open an account with a reliable brokerage, preferably one that offers low or zero brokerage fees for small investors. Fortunately, many brokerages nowadays allow you to start investing with very small amounts. An effective approach to investing with little money is to opt for fractional investing. Many brokerages offer the possibility to purchase fractions of stocks, allowing you to become a shareholder of large companies even with limited capital. For example, if a share of a company XYZ costs $1,000, with fractional investing, you could buy 1% of that share for $10. Another valuable strategy is to invest through ETFs, exchange-traded funds. ETFs are funds that replicate the performance of a specific index, such as the S&P 500. They offer a diversified and usually low-cost way to invest in a group of stocks, minimizing risks while gaining exposure to various companies. Investing in stocks with little money also requires discipline and patience. Don't be swayed by short-term fluctuations in the market. Keep your focus on long-term growth. Study the companies you're investing in, understand their business models, and ensure they have lasting competitive advantages. Moreover, reinvesting the dividends received is a powerful way to accelerate the growth of your portfolio. Harness the power of compound interest to make your money work for you by reinvesting any revenue generated by your stocks. The importance of discipline and patience. Discipline and patience are interconnected and essential skills in the world of investments. Discipline refers to the ability to follow a structured investment plan, avoiding impulsive decisions driven by short-term emotions. To develop this quality, it's important to establish clear rules for your investments and stick to them, regardless of market fluctuations. This involves setting financial goals, choosing suitable investment vehicles, and maintaining a consistent strategy, such as buying and holding stocks of solid companies with lasting competitive advantages. Patience, on the other hand, is the ability to wait for the necessary time for your investments to mature and generate significant returns. The stock market tends to reward those who maintain a long-term view. Buffett's buy and hold philosophy exemplifies this approach, where stocks of quality companies are held for years, allowing the power of compound interest to work in your favor. To illustrate, consider a modest initial investment in a solid company. With patience and discipline, you not only protect yourself against rash decisions during market volatility, but also allow time to amplify your gains. Remember that building wealth is not a sprint but a marathon. Therefore, cultivate patience and discipline, and you'll be on the right path to achieving your financial goals. Financial planning and building a successful portfolio. The first step in financial planning is to assess your current situation. Review your monthly finances and identify areas where you can cut unnecessary expenses. Creating a clear and realistic budget is essential to ensure you have resources available for your regular investing. Remember that consistency in the beginning is more important than the amount invested. Building a successful portfolio starts with defining investment goals. Ask yourself, what is my investment time frame? How much risk am I willing to take? What are my long-term financial goals? The answers to these questions will help shape your investment strategy and determine the appropriate asset allocation. Diversification is one of the keys to minimizing risk. Inspired by Warren Buffett's teachings, seek to invest in companies with lasting competitive advantages, also known as moats. These companies are less susceptible to market fluctuations and have robust long-term growth potential. In addition to stocks, consider other investments such as index funds or ETFs, which allow diversification with a lower initial cost. Work to balance your portfolio among different types of assets, minimizing risks and maximizing returns. Lastly, financial discipline is crucial. Stay informed and periodically review your portfolio, adjusting as necessary, but avoid impulsive decisions based on short-term market movements. By following a rigorous financial planning and applying a disciplined and informed approach to building your portfolio, you'll be well positioned to achieve solid wealth building over time, following Warren Buffett's principles. Conclusion and next steps in your financial journey. After exploring Warren Buffett's investment principles and learning practical strategies for investing with limited resources, it's time to consolidate this knowledge and prepare for the next steps in building your wealth over time. First and foremost, it's crucial to remember that the financial journey is a continuous process. The first step to sustaining your long-term investment plan is to maintain discipline. Regardless of market fluctuations, discipline and consistency are key to success. Invest regularly, even if the amounts are small, and stay focused on your long-term goals. Another important aspect is continuous financial education. The financial market is constantly evolving, and new challenges and opportunities arise all the time. Continue to enhance your knowledge through readings, courses, and workshops. Stay updated with economic trends and changes in laws and financial regulations that may affect your investments. Additionally, review your portfolio periodically. Adjusting your investments according to your goals and market conditions can help optimize your financial performance. However, be careful not to react impulsively to short-term fluctuations. Remember the fundamentals you learned about identifying solid companies with lasting competitive advantages. Do not underestimate the importance of rigorous financial planning. Set clear and specific goals, both for the short and long term. Use financial tools such as spreadsheets and finance management apps to monitor your progress and make necessary adjustments. Finally, leverage the power of networking. Connecting with other investors and professionals in the field can provide valuable insights and learning opportunities. Participate in groups and discussion forums, and don't hesitate to seek mentors who can offer guidance based on experience. Completing this video is just the beginning of your journey toward financial independence. With patience, discipline, and a well-structured plan, you have all the necessary tools to turn a modest initial investment into significant wealth over time. Continue applying Warren Buffett's teachings and move forward with confidence on your financial path. Good luck.